Did the Fed screw up?
I mean, if you zoom out, this is really just more of the same, right? So they've been in this tightening cycle now that's accumulated up to one of the largest in history since the last 35 years or so. And they tend to sort of have predictable outcomes and proceed either or both of a growth slowdown and a significant market draw. And so that's probably what's going to happen here. So, you know, we don't really look meeting to meeting or week to week, but it's part of this broader trend of tightening, extraordinary easing that came out of the crisis.
Theme we've heard this morning already from both Michael Purvis and Ellen Zentner has kind of been, we need to take the medicine. And Jay Powell believes that basically if the markets go down, they go down. That we need to wean off this sort of maybe debt addiction or low rate addiction that we have had. Do you agree with that?
Well, I mean, I think that we've had, really zooming out, 40 years of consistently lower rates, and that's enabled consistently higher debts. And so we're at a point in the global cycle where sensitivity to rate moves is high, it's unmeasurable. The sort of idea of a neutral policy rate, I think, is somewhat academic. And so in my mind, there's just cause and effect, and there's been abundant liquidity and easing, and that's created these excesses in financial markets and in parts of the economy that'll probably work their way out.
We love guests on Worldwide Exchange and CNBC that have these sort of outlier views. And I know that you like the Argentinian market. You ran and did EM research for Bridgewater and Soros.
Yep.
Argentina, they've had like 13 sovereign defaults in 150 years. Why is Argentina attractive?
I mean, you can look at that point one of two ways, right? They've done it before, so they know it's not an easy way out, so maybe they'll do it differently this time. The other point is, you know, they tend to sort of make the same mistakes, and why don't they learn? But the reality
definition
is,
of insanity, by the way.
Right, and you know, it was this hopeful period of you have your first non-Peronist government in 70 years, and you know, lo and behold, they just make the same mistakes as all the last ones. But really, Argentina and Turkey were the two major economies coming into this year that still had big financing needs, and were plugging those gaps with disproportionately dollar issuance offshore. And so when dollar markets tightened this year, they had no choice but to tighten their own policy, engineer immediate closings of their external imbalances, current account deficits. And by doing that and by accepting that tightening and keeping rates incredibly high, both countries have generated stability now, which should.
The other country you're talking about is Turkey.
Yeah, it's the same dynamic.
They made people a lot of money, but it's been kind of shaky lately, but you like them.
Yeah, I mean, it's a similar dynamic. Like 9 times out of 10, these balance of payments adjustments are the best time to buy EM because their markets are pricing in distress conditions at the trough and very acute deleveraging pressures. And so once things normalize and you get an easing of rates, you get the pricing out of that distress and, you know, double-digit returns for extended periods of time. So when I think about trading EM and where the money is made, it's when you can buy these sorts of adjustments at the trough when markets are pricing in default probabilities, equity multiples at 3 or 4 times. You know, and as long as policymakers accept the tightening that has to happen, you get stabilization that follows.